Welcome to the August 2014 edition of Financial Empowerment, a production of the California Society of CPAs and Cal CPA Institute. I'm Bill Spaniel. Probably most of us wouldn't complain if we were filthy rich, but realistically, most of us will never be billionaires or even have several million in our bank accounts. Still, it is possible to be wealthy if we understand that wealth has a lot to do with how we responsibly use the money and assets we accumulate over time. During a Skype conversation, CPA Rob Seltzer, who also is a personal financial specialist, explains how even the average person can be wealthy. Hello, Rob. Welcome to Financial Empowerment.
Hi, Bill. Good to see you.
Nice seeing you. Say, I wanted to talk to you today about how the average person can accumulate wealth and eventually enjoy a decent living and a happy retirement and so forth. So I know you're a personal financial advisor. How would you define wealth for the average person? What does it take for an average person to be wealthy?
To me, it's not living paycheck to paycheck. If you're living paycheck to paycheck, you're sort of living on the edge. Mm-hmm. And you certainly can't be considered wealthy if you're living on the edge. So it's really not a function of income, it's a function of spending. Mm-hmm. I've had clients that made $1 million a year that were living paycheck to paycheck. And then, my parents, who I don't think ever made over $100,000, did not. Mm-hmm. Because it's a function of budgeting and spending less than what you make. And I think that's really the key to wealth building.
Uh-huh. That's a great idea there. I wanted to explore how a young person starting out in a career or in a job can therefore look for a future that they will be financially secure. What sort of tips do you have for that kind of individual?
Well, the two biggest things in terms of cash outflows for a young person are usually their rent and or car payment. And so you really have to put that into your budget and look at what your salary is and what is reasonable for you for each of those areas. And in doing so, if someone happens to be a real car nut, then maybe they get that BMW or something like that, but then something else has to give. They're going to have to eat out less or spend less on rent or whatever. I mean, everyone's going to have different priorities, but you have to realize that you can't have everything. And the big thing for young people to understand is the power of compounding. Mm-hmm. And how critical that is. And so if someone starts saving at let's just use an example, at 25 and assuming a retirement age of 65, which is I think is a bit young because people are working longer, but just for illustration purposes, someone who starts at 25 and someone who starts at 45, the 45-year-old is going to have to put away twice as much as someone who starts at 25, just because they have so many more years to let that money grow. Mm-hmm. And so if you start sooner, then you're going to be way ahead of the game. So how do you do that? Well, for most people, the biggest way of doing so is participating in your company's 401k. That's assuming that you are an employee and that your company offers that type of plan. One of the things that really is critical in that, and which is really a huge error if they do that, is not contributing the 401k up to the employer match. Mm-hmm. That's leaving free money on the table. And so you should definitely do up to the employer match. If you can do more than that, that's great. Mm-hmm. If you aren't working for a company that has a retirement account like a 401k, then you should start doing IRA contributions in lieu of that. And the younger you are and the lower your income, the more you might want to consider doing a Roth instead of a regular IRA, because of the power of compounding and the fact that the tax savings that you'll get In the front part, when you get the deduction for a regular IRA, will pale to comparison in what you'll save in the long run if you make the Roth contribution and let it grow for, let's say, 40 years or more.
Mm-hmm. Well, other than contributing to a 401k or a Roth IRA, what other things could a person do to accumulate wealth?
Well, it's that should be their priority,
Mm-hmm.
because that is something that if other than the Roth, it's something that's going to save them in taxes right from the start. For most of my clients, the two biggest sources of their personal wealth is the equity in their homes
Mm-hmm.
and in their retirement accounts. So the answer to that is saving up to buy a home. One of the things that people sort of take for granted and don't talk about with home buying is it freezes your home payment,
Mm-hmm.
your housing cost. If you're a renter, you are subject to inflation and to the whims of your landlord. And it's not a matter of if it's going to go up, it's how much it's going to go up and how often. Whereas if you buy a home and you don't refinance and suck the equity out, when you purchase that house, that's as high as your house payment's going to be. It's only going to stay the same or lower if you refinance. Now, I realize that we're in a very low interest rate environment, and the chance of lowering your payment in this type of era is much less likely than it was, say, 5 or 10 years ago when we had rates that were higher.
Mm-hmm.
But even with that, if you lock in your payment when you buy a home, certainly you should be building equity over time. And, the real estate market, as we all know, is not fluid. It goes up and down, but over time you will gain equity as a long-term investor. And that's what real estate is. It is a long-term investment. But I think the other part of it that's not emphasized as much is the fact that you are completely avoiding the inflationary exposure of rent. I remember my grandmother had the opportunity to buy a condo when she sold her home. She did not do so. She rented an apartment. Well, even with the rent control in Los Angeles, she moved from a 2-bedroom to a 1-bedroom, and of course had no equity because rent, as we all know, is just for using the space, and it's basically throwing money down the drain.
Mm-hmm.
She had bought that condo, certainly with 20/20 hindsight in California real estate, with buying in the 60s, she would have had hundreds of thousands of dollars of equity that she missed out on.
Mm-hmm.
So I think that is a way for people to build wealth, and for most people, as I started, the home equity and the retirement account are usually their two biggest sources of personal net worth.
I've been doing some reading lately that seems to indicate that people who have a college education and people who are married have a greater chance of accumulating wealth over people who do not have a college education who are not married. Do you have any thoughts along those lines?
I as far as being married, I don't know how valid that is. I have a lot of single clients that are successful that have put away a lot of money, but the education part, I think, is absolutely true. I think that a lot of the blue-collar jobs that you could have with just a high school education have gone. I mean, there's no, GM Plant and Van Nuys making Camaros anymore. So you really can't have a middle-class existence without having a college education. There's a huge gap. You're either in a very low-paying service job or you're a professional, and there isn't that tweener sort of thing. There's a few blue-collar jobs, let's say in the construction industry, if you're a plumber or building homes or something like that, where you can have a legitimate middle-class lifestyle, where but that is skilled labor, and but those jobs are much fewer and far between than they were in the 60s, 70s, and 80s. So I think that the disparity between of income between those people that just have a high school education as opposed to those that have a college degree is only going to increase. But that being said, I think people have to be wary. My wife is a financial recruiter, and I have to tell you, if you have a degree from someplace like Northridge or USC, or I went to UC Santa Barbara, all of those have good accounting programs, and they know that the employers know that you've had a good education. If you're going to some for-profit school, I would really give that a second thought. Employers don't hold that in the same esteem as they would degrees from the colleges that I just mentioned. I think that before people go into debt to get a degree from a place such as that, they should explore other options, especially people that are younger, where they can get their associate's degree at very low cost from a community college and then try to transfer to a state or a UC school, I think is a much, much better option.
Any other thoughts about how one can accumulate wealth and have a more secure financial future?
I think avoiding debt is a huge thing, which goes back to what I was saying in terms of budgeting. The only type of debt that is good debt is mortgage debt, because it's tax deductible. The only one that's, I should say, is passable just because people sometimes have to have it is buying a car. It's not good debt. It's sort of, you sort of have to accept it because not a lot of people have $30,000 to buy a car, and $30,000 is not an extravagant car in this day and age. But certainly credit cards should be only used as a spending tool where you're paying the bill in full each month. If for some reason your car breaks down and you have an unexpected expense and you haven't put away the savings that you should have, well, then that's the exception. It shouldn't be used to buy furniture to put yourself in debt. It shouldn't be used for clothing to put yourself in debt, vacation. None of those types of expenses are legitimate excuses to put yourself in debt. That's just living beyond your means. It should only in an emergency should you go into credit card debt, and then, of course, pay it off as soon as possible, because in most cases the interest rates are extremely high and none of the interest is deductible.
Great. Well, thank you very much, Rob, for talking to us. I think you provided some great information.
Thank you. Great talking to you.
Okay. Thank you for listening to Cal CPA's Financial Empowerment Program, which was produced in August 2014. If you would like to comment about our program, have a question for a CPA, or would like to suggest topics for future shows, write us at financialempowerment@calcpa.org, or simply visit www.calcpa.org. You can search there for a California CPA who can help you save on taxes, better manage your investments, or budget for those rainy days even sunny California sometimes has. Just click on the Find a CPA link. This is Bill Spaniel, and you've been listening to edition 166 of Financial Empowerment, a production of the California Society of CPAs and Cal CPA Institute.